Yesterday at the Economic Club in New York, the president continued his criticism of the Fed, saying it had put the U.S. at a competitive disadvantage, and he also floated the idea of negative interest rates. Do you take comments from public officials into account when implementing monetary policy? And is there any precedent in U.S. history for this kind of criticism or praise from an American president?
So we look exclusively at the data, at the research, and at the performance of the U.S. economy. Those are the things we have a very careful, thoughtful process that's been developed over decades, over a century really, and that's how we try to set interest rates. We don't consider political factors and things like that in what we do.
Thank you. I have a friend in Switzerland who went to borrow $10 million and got a negative interest rate, negative 0.3%. So they're paying him $30,000 a year to borrow $10 million. Do you see any prospect for negative interest rates in the U.S. economy?
Well, negative interest rates would certainly not be appropriate in the current environment. Our economy is in a strong position. We have growth. We have a strong consumer sector. We have inflation that's a bit below target. So the very, very low and even negative rates that we see around the world would not be appropriate for our economy. You tend to see negative rates in the larger economies at times when growth is quite low and inflation is quite low. That's just not the case here. It's different for some of the smaller European countries. It's really about keeping their currency from appreciation, which is the case with a number of those countries.
Yeah. From December 15th through December 2018, there's slow, consistent increases in rates, and we've turned that around with recent cuts this year. Is there enough room to cut rates further if we get another slowdown or recession? Have we given up monetary policy as a tool at the moment for dealing with that?
Well, the typical post-World War II recession has involved rate cuts of close to 5%. The current federal funds rate is in the mid-150s, so we're well short of that, 1.5%. So I think it's a fact not just in the United States but around the world that central banks are going to have less room to cut in this new normal of lower rates and low inflation. So that's why we are conducting this external review of monetary policy at the Fed. We're looking for ways to make sure that we have the tools to do what we're assigned to do by you, which is achieve maximum employment and stable prices even in downturns. And that's what we're going to be doing. I will say also, though, that fiscal policy is often part of the answer, often a big part of the answer when there's a severe downturn, and we would certainly look for it.
Thank you again by bringing up the challenge that the public debt faces all of us here. I was raised to believe that money supply and growth were causally related, that if our money supply grew more quickly than our economic output, that inflation was the inevitable result. But we're less than 2% this year. You have muted expectations. Is there no longer a connection between money supply growth and inflation? Should I pay any attention to modern monetary theories, for example?
Well, so the connection between monetary aggregates and inflation, that's something we all learned in Econ 101. I did. It was important. It was generally thought to be, and empirically it was a good relationship. I think about 40 years ago, as the financial system developed all kinds of alternative forms of money, the relationship between monetary aggregates and growth has just gone away. And so we of course look at those aggregates, but they no longer are a driving part of the theory. It's really the price of money as opposed to the quantity that we look at, which is interest rates.
I'm out of time, but thank you very much.